Investors Chronicle.
Welcome to the Companies and Markets Show. It's Wednesday, the 5th of April. Q2 is upon us, and shortly Easter will be as well. The long weekend means we brought everything forward this week. The latest issue of the IC will be on sale on Thursday, as you listen to this, hopefully. And as I say, we are recording the show on Wednesday. Joining me to chew the fat this week are Mark Robinson. Hi, Mark.
Hi, Dan.
A Restore to Health, Julian Hofmann. Hi, Julian.
Thank you, Dan. Yes. Glad to be back.
And Jemma Slingo. Hi, Jemma.
Hi, Dan.
Now, despite the short week, we've had a lot of companies news over the past 3 days or 2.5 days, not least some notable M&A activity in the commodity, financials and real estate sectors, encompassing Glencore, Rathbones and Industrials Reit. We'll be talking about those shortly, along with a brief look at full year figures from another soon-to-be acquired business, funeral provider Dignity. But we are going to start with food packaging business Hilton Food Group, which reported its own annual results this morning. This is a company, Mark, like so many, that's been facing sizable inflationary pressures over the past year. Unlike so many, it's not been quite as adept at navigating those. Is that fair to say?
Yes, up to this point, yeah. But I think that, in a sense, that partially reflects the integration process, because it acquired 3 businesses throughout the year and entered into a joint venture too. It's interesting because I did look at benchmark holdings as well to try and get some a lead on what's happening in the world of seafood, because one of Hilton's acquisitions through the year was a Netherlands-based fish company called Hofmann. They make specialist smoked salmon products. And the trouble with it is, when I just looked at some of the companies, Hilton's unique key performance indicators, they suggest that process is still going to be ongoing. Because if you look at the adjusted operating margin, it's expressed in pence per kilogram, strangely enough, that's actually fallen appreciably over the last year, while employee and labor agency costs have increased also, and they put this down to the term they use is greater labor complexity in the recently acquired businesses, including Hofmann. So I think it might be a little bit premature to make a judgment on their ongoing profitability as well, because it's going to take a while to bed these new businesses in. And it's also significant too, the joint venture. It's an Australian joint venture they've entered into, and it's with a company that specializes in automation linked to food supply chain. So this indicates that Hilton is making a push for efficiency in that respect. It's certainly not unique. I did have a look at a few other figures as well. It's at the moment it's trading pretty much in line with others in the sector, such as Cranswick at 13 times forecast earnings, and there's an implied forward yield of just over 4% as well. So it's not terribly expensive, but I think what's more significant than anything else is that when you look at the consensus figure, they're pointing to a gradual increase in free cash flow yield and also return on equity, which suggests that most analysts think that those acquired assets will eventually integrate and start pushing growth forward for the business.
As you say, it is early days. There's certainly not an indication of any goodwill being written off or anything like that yet, despite the fact is that the seafood side of the business that is struggling a little bit, or has been over the last year, specifically with passing on costs as quickly as they'd hoped. I do know some analysts did say, I think before, at the time of the deal, that Hilton's tradition is very much into the meat packing side of the business. That is still the majority of its business. But some analysts were a bit concerned that whereas they have the ability to pass on cost and even cost plus increases in that side of the business, the salmon side might prove a bit more difficult. That does seem to be in the case so far. But as you say, if they can get these kind of automation improvements working in train alongside the new arm, then that's potentially good news for the future in the medium to longer term.
I mean, investors will be put off by companies like this, or some investors will put off companies like that, given the fact they're traditionally lower margin businesses, although they do offer a degree of clarity on forward revenues as well, which you don't get in certain other sectors. The point that you made early on is significant as well, given that we've just seen Saudi Arabia announce that they're going to cut back their production levels. Now, there's a direct correlation between food costs and energy costs, and we were only just starting to get over the energy price surge that that occurred around about the time of the Russia's invasion of Ukraine. Now you've got the situation is likely to deteriorate again, and we should acknowledge also that food price inflation is easily outstripping the general rate too. And there was this doesn't affect the fish business quite so much, obviously, but the price of nitrate fertilizers is going to start creeping up again now. There's been a significant amount that's been removed from the market because Russia and Ukraine are both large producers. Investors should take that on board before they look at any food companies going forward.
Yeah, the Saudi Arabia production cut you referred to, obviously we're talking about oil here and that input. I mean, there hasn't been a huge spike in the price, certainly when you of crude oil, certainly when you compare it to this time last year. We're still quite a bit down. So for commodity, price takers, they have a bit of hope from that there hasn't been that much of a move. There also hasn't been too much of a move from China's reopening, which is contrary to what some people, perhaps myself included, thought at the start of the year. But as you say, nitrate fertilizer, it could be an issue. Certainly food price inflation currently seems to be outstripping everything else by a considerable margin.
I think the problems, there's a bit of a lag with these problems as well, because they are, I think they pointed to the winter planting season as being the significant one. And if primary producers, if they look around and say to themselves, well, our margins are wafer thin as it is, what's the point of buying in excessively priced fertilizers? And so just overall yields are going to fall going into next year perhaps as well. So we'll have to wait on that score, but it's not a positive development at any rate.
Yeah, as you say, those margins are razor thin. Hilton Food Group, I think, let me just bring up the figure, 1.8% operating margin last year, falling from 2.2% the year before. So, very little wiggle room there still.
Yeah, it's a volume trade, isn't it, at the end of the day?
I think that's probably why they brought in the co-op guy to take over as chief executive, isn't it? There was a change of management announced today alongside the results.
That's right.
And they brought in the co-op guy to run the business from July. And I mean, I think I read that partly as the previous chief executive, Philip Heffer's, just retiring, basically. But you could also see that as bringing someone in who has experience of managing quite low margins in a volume business, which is basically what the co-op is as well. Almost like a food producer as well as a seller as well in many ways. They have some, like the largest farms in the UK apparently, that does the co-op. But
yeah, it's a good point. We should, as you have done, talk about the change of management, because I don't think that will signal a change in strategy and overhaul, but it's something to keep an eye on, as always, with these executive moves. One final point, Mark, you talked about the valuation, just to return to that briefly. One company we look at elsewhere in our pages this week is Cranswick. The relative valuation argument for these two businesses, is that an easy case to make for one or the other? To you, is it much for a muchness? How do you see that?
Certainly, as things stand at the moment, you get a better return with Cranswick. But as I mentioned, the general feeling among analysts is that return on equity is going to creep up for Hilton over the next 3 years going forward, along with their cash flow yield. So I mean that seems to me to be an indicator that they think those acquired assets will help over the long run. Whether you would really recommend a business just on the basis of the implied dividend yield, well, perhaps it's not a great ask at 13 times forward earnings, but it's pretty much in line with the sector.
Yeah, a work in progress for now, I think it's fair to say.
Yeah.
Let's talk about another business, Dignity, a completely different business, obviously, a funeral provider, and also a business in a completely different stage of its public life cycle, because there is a bid on the table. It has been recommended. It does look like that will probably go through. We'll come to that in a moment, but nonetheless, the company continues to report full year figures. Jemma, you covered these, and notwithstanding that deal, it is still a bit of a troubled time for the company, as these figures suggest.
It is. And I mean, Dignity is quite a gloomy company to read and talk about anyway, so please excuse some of the morbid comments I'm about to make. But on a simplistic level, it does look like conditions are pretty good for funeral providers. I mean, it said in its full year results that demand for funeral services was still higher than average coming out of the pandemic, and it does actually track death numbers in its financial highlights. But despite that, the company is still struggling. So revenue is down by 9% in 2022. And worse than that, it reported an operating loss of almost 200 million. So clearly something isn't going well. And it seemed to be that it was partly down to external factors. So for a while now, the management team has been noting a trend towards lower price funerals. So one of the lesser known consequences of the cost of living crisis, I suppose. And there's also been a rise in branch direct cremations, which basically pared back ceremonies, which are a lot cheaper as well. And on top of that, there's also been problems with staff shortages, which isn't necessarily that surprising given the nature of the industry. So all of those factors have basically meant that Dignity has been struggling to grow its market share. And this led in turn sort of this big impairment that came out the other day, 196 million, which again fueled that operating loss. So clearly things aren't great at the company.
And cash flow as well, all these things having or most of these things having a knock-on effect on cash flow, and borrowings too, a bit concerning at the moment.
Yeah, it's interesting because for a long time management has been turning to external factors to basically explain why it's in the state it's in, but a lot of the issues seem to relate to cash and debt. So basically cash has dried up at the company. I think it was 7.7 million pounds of cash on its balance sheet at the end of 2022, compared to about 56 million the year before. And operations are now just sucking in cash. And this means it's basically got into this vicious cycle with debt, because it needs to keep borrowing in order to, keep investing and just keeping the business functioning on a day-to-day. The group expects to draw £45 million from its liquidity facility in 2023. But now the big question basically is whether it can actually repay that debt, because both S&P and Fitch downgraded its credit rating this year. And there are signs in the report that trouble may be coming. Buried in the depths of the report, it noted material uncertainty with respect to covenant compliance. And there are more details of those in the notes itself for listeners who are interested.
Well, this does lead on to the offer that's on the table. And when we look at the list of issues that we've just iterated there, it would seem to make sense to perhaps to accept that offer. But at the same time, there have been concerns in some quarters that it was a bit of a lowball deal. Our own Bear Bull columnist is one of those who has voiced concerns over the past few months. Mark, maybe we bring you in here, though. Perhaps when you look at the fundamental health of the business, I mean, it does seem like this deal will likely go through anyway. There hasn't been much mutterings of a shareholder rebellion or a push for a higher price. There were a few attempts to make this offer before the company acquiesced, shall we say. Do you think at this stage it's something where shareholders should just accept? What's your kind of view of the business?
Well, if I was holding shares in the company, I would certainly accept at the moment. The rationale behind the approach from the consortium, and that includes Phoenix Asset Management there as well, it is difficult to know. And I don't know if this will just amount to a type of asset stripping eventually. The point that Jemma made earlier on is significant as well. The fact that we're seeing a trend towards cheaper, no frills funerals as well may have something to do with the deal too, unless they, perhaps the consortium are looking at cornering that part of the market itself. You look at the level of debt, and basically it was around about twice the market cap of the company as well. So you really haven't got that many options as a shareholder, I don't think. I would grab the money, to be honest.
We should say as well regarding the offer, the consortium, as you say, involves Phoenix, but also is being fronted by Gary Channon, who until 7 months ago until about 10 months ago now, was the chief executive of Dignity. So I think that has led to the Bear Bull article was talking about, what does he know perhaps that shareholders don't, but as you say, maybe the debt issue is the most paramount one. I think the consortium has said, as a private company, they'd have access to a lot more funding, or certainly funding that's easier to access. So he may simply be thinking the time as a listed company, given the debt pile has come to an end, this is a good opportunity for a long-term holder to do something that public markets can't do in this instance.
Yeah, so let's hope that sort of, from his perspective, that sentimentality isn't playing a role in that decision.
Indeed.
It was interesting. When I was reading the results, it just struck me that some industries, I don't know, there's a question of whether some industries do suit big listed companies in a way, because obviously the funerals market is generally very fragmented. And I think one of the issues that Dignity has faced is by being this very big conglomerate in a way, it hasn't been able to connect with its customers in the way it may have wanted, because it said it was trying to put more emphasis on its regional branches and gain more local knowledge. And it seems, when someone's died, you want sort of a face and a human element to the service, which I don't know. It sounds like maybe Dignity has been trying to generate that sense a little bit more, but might not have always been successful in, really.
Well, presumably as well, there must be fewer religious themed funerals nowadays as well, and that seems to be a wider trend in society. There certainly is that trend, though. I mean, I know, I was going to say from personal experience, but that wouldn't be right. But some of my friends have been looking at costs involved with funerals, and the emphasis is squarely on saving money.
Yeah, my wife's a reverend, and she does quite a few of these. And basically, everyone just comes up, sings "Abide with Me," and then goes to lunch. So it's not really there's no particular dignity involved in it.
Well, yeah, as with any business, as Jemma was saying, I suppose from the company's point of view, there's that balance between being a large company, diverse in terms of number of outlets, if you want to use such a crude word in this context, and having that personal touch, which is pretty crucial in this context, obviously. So yes, it does look like the time as a publicly listed company has perhaps come to an end. That is not the only M&A deal, though, on the table at the moment. There have been a lot in the past few weeks and months, keeping up the trend of the past 18 months, really. And this week alone, as I touched on at the top of the show, we have seen quite a few interesting deals or takeover attempts being made. We'll start with the first one of the week, I think, in chronological order, which was the deal for Industrials Reit, the warehousing real estate REIT, by Blackstone, the US real estate manager. Now, Blackstone has been quite a big acquirer of UK businesses in recent years in this, or certainly in the real estate space, and Industrials Reit is its latest target. Julian, I know we've been discussing separately some commercial real estate potential issues coming up in the UK and the US, perhaps on the back of the credit crunch, given all the stuff about banks we've been talking about over the past month or so. This deal is quite interesting for a couple of reasons, but it does perhaps show that, the warehouse sector, or this specific part of the warehouse sector, is still of interest to a lot of buyers, despite the bubble having deflated somewhat over the past 12 months.
Yes, I mean, Blackstone is the latest proud owner of a load of warehouses on the A30 somewhere. It's an interesting deal, as you said, because the REITs at the moment are going through the process of revaluing all their assets for the first quarter of the year. So it's quite a key point in time for that sector. And contrary in essence to a lot of expectations, the growth in prices for individual assets and REITs has not matched what happened last year, which actually was quite stable in many ways. And this year, the average prices have fallen generally by about 13% across the board. So Blackstone's timing, you could say, is entirely commendable. So they're picking up a relatively cheap asset, which, given the ongoing demand for warehousing space all over the country for various functions, including things like home shopping and things like that, means that they've actually picked up a reasonable bargain, I think, in this context, and also because everything in the UK is cheap by US standards. I mean, as Alex Newman was pointing out recently, Blackstone is also under pressure in the US because of its real estate concerns post the Silicon Valley Bank. A lot of these companies or investment companies, and this stretches right down into the insurance business as well, have increased their exposure to commercial real estate quite substantially. I was looking at this morning, it's something like tripled in value since 2005, partly the result of looking for yield at a time when yield was difficult to find. And the problem that holding that level of real estate poses is that once interest rates on long dated bonds go down and cash becomes much more attractive, investors have very little incentive to stick with this type of commercial real estate. So that is a problem for Blackstone if it's increasing its exposure at this rate. But it has to be said that given the discount on the underlying asset, it might be one that could be priced in, I think you could argue. But we'll see how that works out.
Blackstone does attract a lot of attention in the last few months because of its real estate fund, which it's continually gating due to outflows. I mean, it's entitled to gate it, but I think it's a 4.5 billion fund, the Blackstone Real Estate Income Trust, US focused, not available to UK investors, but a kind of a sign of the pressures, or at least the outflows. So it's a $70 billion dollar fund, I should say. The 4.5 billion were just the latest outflows.
Just the latest outflows.
Yeah, so it does show the size of that portfolio.
But there is a real problem. I mean, the United States has something like 20 trillion of commercial real estate on various people's books. Say, if they're experiencing that level of outflow, then you could only hazard a guess at what the rest of that sector is looking at. So it could be quite a significant problem. But in the UK context, I mean, our take would be that they are buying something at a really reasonable price that has a discount built into it.
Am I right in thinking that they're actually a very large residential landlord in the US as well? I seem to remember they came under some criticism at one point because of basically they were shrinking the pool of affordable housing in certain areas. And I think they were also accused of pursuing aggressive evictions and, pushing low and middle income tenants out of the market.
They do own, I think they own pretty much every type of property in the US nowadays, which does include apartment blocks, things like that. So they do come into contact certainly with residential real estate issues and reputational issues, so shall we say, as well. But just to return to Industrials Reit, as you say, Julian, potentially a good deal there. The discount on UK assets is clearly attractive to Blackstone. They bought some Modwin, another logistics REIT, a couple of years ago. The interesting thing, perhaps, on this deal was there was a bit of an uptick for various warehouse REITs on the back of this announcement on Monday. But as Mitchell Labiak, our property correspondent, has written before, Industrials Reit is slightly different from these big box warehouses. It buys some smaller multi-let industrials, hence the ticker MLI. So the likes of Amazon, which sparked this big sell-off last year when it said it had effectively overextended its warehouse space in the UK. Amazon is not a tenant of it, Industrials Reit. So it is slightly different, something to watch there if you are looking for read across.
Yeah, it's probably the sort of this type of thing you'll find on the edge of Bridgewater. Would be the sort of way to describe it. Lots of different types of businesses, small businesses, and retail outlets as well, I think, play a part in that business model. So, I mean, you can't argue. I mean, I'd say it's an astute thing that Blackstone have done, but I mean, only time is only going to tell how that works out. But it was definitely there for the taking, I would say.
Well, let's turn to another deal, Glencore. Mark, maybe I'll bring you in on this in a moment. Just when the details of this offer, because it's a little bit complicated. This was an offer for Canada's Teck, and that's TECK, not a diversification strategy from Glencore. And this was rejected, but it was an interesting offer for what it implies about the company, that's Glencore, as much as anything else, because the idea was to buy Teck, combine businesses, spin off a combined business of metallurgical coal and Glencore's thermal coal, which is sort of contrary to what Glencore's been saying up until last month, even, or the month before, about, you know, being insistent it was going to run down its coal business. Coal obviously has been a big money spinner for it in the past year, contrary to some expectations, given what we've seen with energy prices in general over the past year. So it was quite a change in terms of the coal strategy, if this deal does or did or had gone ahead. And also seems to be another play for a copper acquisition. We've seen a few miners in the past year, a few of the big players, BP with Oz Minerals, for example, looking to increase their exposure to copper, given its role in the energy transition. Now, this deal has been, you know, rejected by Teck. They do seem to have a bit of a poison pill family ownership arrangement. They are going through their own demerger situation at the moment, which might seem to preclude any comeback from Glencore. But I think some analysts are now thinking about Glencore having said, no, we're going to stick with our coal business, and having insisted that this was a one-off deal and there's no plans to spin off coal otherwise. Some analysts are thinking, well, maybe actually getting rid of the coal business or hiving it off might be on the cards in future now.
Yeah, the first thing that I thought of when I read about the proposal was Teck's management, or their fiduciary duty to shareholders, and I was going to go on a little bit of a rant about that. But then I thought about it, and the reason that they cite is that they wouldn't want to force Teck shareholders to hold large thermal coal holdings, which they said would be value destructive over time, drive away future investment as well, which is quite a salient point when you think about it. It's got to the stage now, because of the various mandates linked to fossil fuels, that it's increasingly becoming a no-go area. And the management may well have been well within their rights, even though my initial reaction was somewhat hostile hostile to the news.
Well, this is, as you say, the split between Glencore's thermal coal, which is a no-go area for most companies, but as I say, has been a big money spinner for it over the past year, versus Teck, which is focused on, you know, steel making coal, i.e. metallurgical coal, the export of that. So although ostensibly it looks, perhaps to the less well versed, it looks like a sensible combination, there is a distinction between these two types nowadays, particularly with regard to energy transition, but also sustainable investing mandates and things like that, in terms of how people view these businesses.
Yeah, well, I think a lot of people were actually surprised about the price direction of brown coal over the last year or so, but that's down to external factors, specifically, again, Russia's invasion of Ukraine.
As I say, the copper side is interesting too. I think it would have created the world's third largest copper miner. So perhaps we can expect more activity on that front as well. Let's turn to the final M&A discussion of the day, and that one is quite close to home, perhaps for a lot of listeners. Certainly, it's a sector that I know quite well, and Julian, you too. It's the wealth management space. No stranger to merger and acquisition activity over the past few years, and there's been a particularly big one yesterday, on Tuesday of this week. I think it was yesterday, maybe it was Monday. I'm losing the track with this bank holiday curtailed week.
Yeah.
Anyway, Rathbones buying Investec's Wealth arm, or merging with it, if you will, but it seems to be keeping the Rathbones name.
It's very much an acquisition, I think.
Yeah.
It looks at
Yeah.
it. So the story behind this is that Rathbones, which is a venerable wealth manager of some repute with lots of offices in pleasant county towns, has bought out effectively the wealth and investment arm of Investec, which is the South African listed, UK dual listed wealth manager and bank. They've essentially bought their UK, what they call the W&I business, which is wealth and investment rather than Women's Institute, for a consideration of something somewhere north of 830 million. So that's what the value of the deal is in an all share deal. And when you look at the fine print, basically, Rathbones has 70% of the company, Investec investors somewhere around 30%. So it's reflective of the relative size of the two wealth arms. Arguably, Rathbones has a much bigger presence in the kind of retail market here in the UK than Investec's business did. So yes, that's how it's reflected. But I mean, it's very much indicative of what's happening in wealth management as we look at it, because over the last year to 18 months, several fondly remembered names have disappeared, including Brewin Dolphin went into the Bank of Canada. Essentially, you can read it really as it is a sector that is always primed for consolidation because it's so fragmented. So Rathbones making this move is entirely comprehensible. And they've also been trying to diversify the business a lot anyway. So they made a lot of unlisted acquisitions over the past year as well, in kind of higher end pensions management, that type of thing. So this is sort of an extension of their acquisitions policy, but also give them quite a lot more firepower when it comes to the underlying wealth management business itself, or a lot more scale, as it were. I think that's what's bringing it here.
It gives them, I think, 100 billion in assets. Investec Wealth, to be fair, they're not the storied Rathbones name. They did have a decent presence in wealth in the UK. I think they had about 40 billion in assets, so contributing a decent amount. But certainly that 100 billion size puts the combined business, right at the top of the UK wealth market.
Yeah,
probably raises questions about again, the quality of service that can be provided, and whether everyone's going to continue to get the bespoke individual service that you really want from a wealth manager when you're paying all those fees. But that will come out in the wash.
Well, it will, I guess. I mean, Rathbones' structural problem was always that it was a relatively small part of the business that generated all of the profit. So they have to kind of reorganize anyway in order to become qualitatively more profitable. So basically it was their unit funds that funded everything, and I think that this Welsh management merger probably gives them a scale in the parts of the business where they want to grow, which is more like this pensions management, which is really the next big thing, I think, in wealth management, given the number of defined benefit schemes that are maturing and people are retiring now. So that's essentially where they're headed, I think.
Yeah, that complexity is certainly a big part of wealth management now. But of course, you can always turn to Investors Chronicle for help with that kind of thing as well. The deal valuation as well struck me. Quite often in this space, deals are a very simple basis. Back of the envelope calculations are just price as a proportion of assets, and that what stood out in this deal was about 2%, which is quite a bit lower than some of the deals. I think it's about a third of what RBC paid for Brewin Dolphin as well. So, obviously we are in a higher interest rate environment now, but potentially not the most expensive acquisition. The other thing to touch on, which we do touch on in the magazine this week and we'll be looking at in more detail next week, is what implications this might have for the world of investment trusts, because wealth managers are quite big holders of investment trusts, quite high up the shareholder bases. And there's been in recent years a question of liquidity as wealth managers have got bigger. The type of trust they can hold gets bigger as well. That is only going to be exacerbated when you merge two giant wealth managers into an even bigger one. So there may be some share overhangs for certain smaller investment trusts which are currently held by both businesses, but may ultimately prove to be too small to be held by the combined business. So we'll be discussing that in more detail next week as well.
Well, that's another sector that's primed for consolidation, really, isn't it?
Well, yeah, this could be an example of consolidation in one area, accelerating consolidation in another. But that does bring us to the end of today's show. Unfortunately, that's all we have time for. But thank you to everyone. Thank you to Julian, to Mark, and to Jemma. And thank you to you for listening. We'll be back next week with another Companies and Markets show.